down a dirty road. Started out.
John, we got the prime spot here right before lunch. So you got to stick around to know when to go to lunch, right?
It is great to be the only thing standing between your audience and the lunch buffet. So great to be here.
Well, it's exciting to be up here because misery loves company, and there's nothing like a company that's been talking about the great freight recession for the last 2 years to bring up somebody that feels equal amounts of pain in another adjacent but similar industry.
We are right there with you. We feel your pain. We analyze it every day and sort of provided data and intelligence to our customers on an industry, a couple industries that are really, really closely linked to, specifically to trucking.
The great box recession, typically, right, you guys have seen pretty similar growth to GDP, but over the last several years been a little faster than that. What are the dynamics of the paper packaging box industry and what you do at Fast Markets for covering those paper products world?
Sure. So just really briefly, Fast Markets is a PRA. We do a lot of the industry pricing that our customers, a lot of your shippers, will index their product prices to. We discover and print those prices. I lead our analytics team that does a lot of analysis around supply, demand, capacity, production, shipments, and some forward-looking forecasts. So we're analyzing that all the time. And if we focus just maybe on the containerboard sector, containerboard is the grade that's used to make boxes, that great packaging material that produces a lot of the goods that are shipped. And if we think about that industry, like if we go way, way back, that has been an industry that historically, in the 70s and 80s, it was a GDP plus kind of business. It was always growing, consistently growing faster than GDP. In sort of like the mid-90s, when we had about the same time, we had a wave of mini mill recycle capacity installed in North America. It became sort of a GDP flat kind of business. And then over the last decade or so, it's really been sort of a GDP minus, a GDP negative business, growing a little more slowly than the economy, and that completely changed. We've heard a lot about pandemic trends today. Completely changed during the pandemic, when for a year or two there, things really got turbocharged, and it became a GDP plus kind of business. And then we sort of felt a hangover from that.
So anybody that is familiar, listened to John there and thought, man, that sounds awfully familiar. One of the great things that we were able to do as we were thinking about doing this presentation is to grab some of your data and put it up against some of our data in a chart here that we have in Sonar. So if we get this chart up here for us to show, that is not my face, but is instead this pretty interesting deal. So what you shared with us is the cardboard box data on shipment volume over the last 3 years, and we rolled that up in a chart here for us to be able to present that basically shows outbound tender volume at a quarterly basis, your shipment box volume from a quarterly basis too, and we'll get back to it later.
It is amazing when you see that data, sort of how closely coupled they are. We can sort of have a number of interesting discussions about which is the leading and maybe which is the lagging indicator, but when you overlay that quarterly type of data, it is amazing sort of how similar the run-up was during the pandemic, sort of the momentum that was maintained, and when momentum was lost, it was quite dramatic in both sectors.
Yeah, it's been pretty interesting too. It's like, the big question I thought our audience would appreciate is really just to be able to understand how you're projecting kind of the recovery, or if you're seeing that. I mean, one thing that's obviously very different with our industries, right, is you can buy a truck in our industry and add capacity to the marketplace. It's a lot harder to add a mill or any other type of capacity to the box or paper products industry. So do you see capacity coming offline? How is the industry dealing with kind of this pretty significant drop from the COVID era?
Sure. So it's a very good point. The forest products industry, pulp and paper specifically, very, very capital-intensive industry. For new integrated pulp mills, it's a billions of dollar type of investment, even for sort of one single recycled mill, recycled containerboard mill, which is still being installed in the U.S. Hundreds of millions of dollars to one of those. And when they come online, they don't come online in very small increments that ramp up. They come in line in big chunks of capacity that have a meaningful impact on the industry operating rate. So, the first thing that we saw as sort of box shipments and containerboard shipments declined, industry operating rates fell to low levels. Margins sort of didn't have as much of a hit as they may have during the Great Recession or earlier times. Margins have actually held up pretty well, despite low operating rates. But, the first thing companies will do is look to close some higher cost capacity. And we have seen over the last 12 to 18 months a number of facilities, actually 4 fairly large containerboard facilities with something like 2 million tons of capacity have come offline. The interesting thing is that capacity, because of some planned investments, during times when shipments were much higher, there were some planned investments of 4 recycled mills that have kind of come online at about the same time. So it was sort of a wash of net capacity in containerboard, if you will.
Interesting. So we got our chart up here finally, and the correlation is uncanny, right? If I didn't tell you that the blue line was your cardboard box shipments and the orange line was our outbound tender volume, you couldn't tell which one.
If the data folks mix those up overnight, your viewers, customers may not notice in their terminal until they really drill down to specific quarter data.
So what are you seeing from a demand perspective? I mean, we've seen it from our side to pick up at levels that exceed the kind of pre-COVID 2019 era, above our 2023 levels. Are you guys are still running a little shy of your kind of pre-COVID levels. Are you seeing a pickup in that demand?
We are seeing a pickup. So last year it was pretty extreme. Box shipments were off by about 5% last year. So a number of you may have seen that in 5% lower volume that was shipped in boxes out there. We are up from those levels now. This year we're predicting box shipments and containerboard shipments. The containerboard used to make those boxes will be up somewhere between 2 to 2.4%. So we're on the way to recovery now. But essentially what it will take is another year, 2025 and into 2026, of 3+% growth. Call it 3 to 4% growth, to get back to sort of that long-term trend level that we would have been on shipments. So we're not at 2016 levels anymore. 2017, we're clawing our way back, but it will take a couple more years of recovery to get back to that long-term trend level. And that is what we are forecasting in our analysis.
And one of the things that's happening in your industry too is there's a lot of consolidation. From some of the big guys are coming in and using this kind of recessionary time to buy out some of their competitors, and you're already starting to see international transactions in your market.
We really are. It's a good point that you make. Sometimes when there's sort of a downturn in an industry, folks take a bit of a breather. There's not a lot of organic growth to be had, so the M&A machine starts to churn a little bit, and folks look for growth through acquisitions, and that really is what we've seen. It kind of makes sense that a lot of those transactions are happening either offshore or sort of an international transaction. The North American industry in containerboard is very concentrated right now. It's tough to see a number of the big players getting together and getting those deals approved, but there's really good opportunities for some international folks to look further afield. So the first one that was announced last year and should be closing later this year, actually later this summer, is Smurfit Kappa, a large European producer, acquiring WestRock, and that is on track to close this year. So that will be Smurfit Kappa has very few assets, a very small percentage of their capacity operating in North America. WestRock does not operate in Europe, so a very large sort of international type of deal. Europe is not as consolidated, and there was a European regional consolidation deal that was announced between Mondi and DS Smith, and now International Paper has outbid Mondi for that. So that deal is on track, unless the sort of a late sort of arriving deal of the world's largest market pulp producer, Suzano, has announced that they are interested in, or may be interested in, acquiring all of International Paper. So the story's still being written about that one. We'll see how it plays out. But one thing is for sure, that in the forest products industry, M&A is back for now.
It's interesting. And our industry, it's so different in that way, right? Brokerages, as you're building a brokerage, it's much easier to I should say easier. It's probably easier to buy something. It's cheaper to build than it is to buy. And it's a human capital, variable cost industry. So you hire the best folks. You can't exactly hire a mill, right? So and we have seen a little bit of consolidation on the carrier side. Some of the big enterprise ones with U.S. Express being bought by Knight-Swift. But you're really seeing it more, I think, in the asset-heavy side where it's hard to replace a mill, I should say, with
It is sort of the buy versus build. There are different companies with different approaches in our industry. I really like the first discussion this morning with the UPS executive talking about expanding in Kentucky, because we do have a customer in our industry that has built a brand new container board mill in Kentucky, making lighter weight board, perhaps for a lot of those e-commerce shipments that will be originating there. So there certainly are companies that sort of have that build first mandate, but I would say in our industry, the predominant way to sort of expand capacity in sort of these mature industries has been buy versus build.
So paper, just one part of kind of what the market looks like for wood products. As you're thinking about kind of the box industry and setting aside, another big part that affects our industry here in transportation logistics is the lumber side. You guys obviously cover that side as well. What are you seeing with housing, interest rates, clearly big drivers of demand there?
It really is. It really is all about interest rates. If we think about the things that keep a number of my economists up at night, especially the ones focused on the housing-driven industries. And by wood products, we mean things like lumber, OSB, MDF, all the structural components that go into making a home from wood. Those are the industries that we cover as well. Of course, there's a lot of geopolitical things. War in Ukraine and the environment, and we've got elections coming up. All those things are super important. But the number one thing that sort of keeps my economists awake at night is what is going to happen with interest rates. Are we still on track for 2 rate cuts this year? What happens if the Fed delays one of those? Because it's just a sort of a fact that the longer the interest rates stay higher, the longer it will weigh on affordability of housing, and especially on multifamily type of housing.
That's interesting. So if you're, so your guys are forecasting. Are you still forecasting 2 rate cuts from your economist standpoint here?
That is still our base case. We'll see what we've got. Sort of a 1 or 2 good inflation points, not good, but better inflation points now from a Fed perspective. We'll see if that trend continues into the fall. But I think like most people, we're sort of thinking September, December, we could still get to.
Yeah, I think it's certainly one that every print of the inflation data is basically causing everyone in the financial markets to reprice risk, reprice, bonds, reprice lumber, and paper products. So that's really interesting. Lumber. I built a guest house during the COVID recession. I think I paid a pretty penny for that. How are we seeing on lumber prices relative to kind of the COVID spike? Does it look like this chart here, or how's it evolved?
So if we had a lumber pricing chart up there, what you would see were sort of two major peaks during the recession timing. You and sort of 50 million other Americans all built guest houses, sheds, porches, whatever we could build at home, because Home Depot and Lowe's were just about the only places you could go to during lockdown. So that sort of that over the shoulder do-it-yourselfer market and contractor business was really substantial during the pandemic. We saw 2 sort of rate spikes. Since that time, we have been sort of on a very, very long, low, flat period. So at or near break-even cost for many of the higher cost facilities now. We've seen a lot of lumber capacity come out of that marketplace. And until we really start to see housing starts sort of gain some momentum, housing starts are down about 2% this year versus last year. It's really a tale of 2 marketplaces out there. Single family is actually holding up, pretty okay. It's really multifamily is suffering again because of high interest rates. Starting new projects is becoming more of a challenge, because if you think about it, when you're sort of building apartments, you can't have the same sort of creative solutions to interest rates like builder buy downs and others that have really helped single family.
Yeah, from a consumption standpoint of lumber, how does multifamily, single family split? I feel like the popular economic culture is really tries to do single family home starts and or I should say, initial home starts as part of that metric, but how much of that is actually multifamily?
So if we think of sort of so right now, housing starts are around 1.4. I think our prediction for full year is like 1.4 million housing starts today. About 1 million of that will be single family. About 400,000 will be multifamily. Right now, the current number for multifamily is more like 340 versus 540 last year. So we'll see exactly where that shakes out and where interest rates are going. But it's so lumber uses. We use more lumber to build a single family house than we typically do apartments, and single family is the larger number in there. So single family really is the driver, but we can't forget about multifamily, especially for all the other building products, trusses and joists and the other products that go into multifamily as well.
So, I mean, if we have advice for the audience, right? And if you got the cash, now's the time, right? You're not going to pay out for lumber. Now's the time to build your guest house. If you didn't build it already, maybe build a second one.
Especially if you already have the land. if you don't have to buy the land, building materials should be able to be much more affordable, certainly than they were over the last 4 or 5 years.
And buy your products on Amazon, Walmart, et cetera. Just get those packages delivered in those boxes. It'll help both of our industries, right?
And we do see an upturn for housing next year. Our forecast for housing starts in the U.S. next year is about 1.5 million, so up 7.9 or 8% for next year. So we are more optimistic going into next year, and we do see sort of a steady improvement of interest rates. But if you're holding out to get another sort of 3 or 3.5% loan, if that's what you're sitting on now, we don't see that coming back anytime soon.
Demographic-wise, what underpins some of that housing start side? Some of it clearly is interest rates, but another piece of that clearly has to be demographic trends. Like, what cycle are we seeing in today's environment?
Well, it's a bit of a continuation of sort of some of the cycles that we've seen is, we do have a problem with sort of chronic underbuilding in the U.S. In terms of providing sort of just new shelter units, we have underbuilt. We certainly think that sort of that trend level of building is certainly above the 1.5 million starts that we will be at next year. So, some people have been living at home longer, or some people have been sort of sharing space longer than they would have in a different economy with different interest rates. And I think the sort of the first-time home buyer market is pretty important to look at as well.
Yeah.
If we think about sort of first-time home buyers, which make up still a significant amount of home buyers, a lot of people ask the question of, is that sort of starter home market gone? Has it changed forever? And our answer would be like maybe. It's not completely gone, but it may be changed forever for two reasons. One is because home prices have increased, and with higher interest rates, affordability is at the point where in the past where 50 or 55% of home buyers, first-time home buyers, could afford the medium-priced house in a given marketplace. That number is down to like 30% right now, so it's decreased dramatically. But at the same time, if you talk to the National Association of Realtors, they will say that first-time home buyers are still a really, really big part of the marketplace, with something approaching 30%. So they may not be the traditional first-time home buyers that we're used to see. They may be a bit older. They may be getting some help from other family members, but sort of first-time home property buyers are still an important part of the market.
So if you had to leave us with a set of guidance to how, like, our markets are pretty similar, what are some tools that our audience could probably look to get a sense of how other industries might impact the transportation and logistics world?
Yeah, if we think, again, back to the corrugated box example, because it was really, really mirrored the trucking data, slow and steady recovery. We do believe, we've heard it from sort of all of, a lot of your customers, a lot of our customers in their public earnings calls, that the belief is that the sort of the massive destocking that was out there in the supply chain is coming to an end. And if we think about the box side of things, that's not just the products at the local grocery store, but back to their warehouse, back to their distribution center, back to the manufacturer, and then that manufacturer sort of orders boxes. And when they were on allocation during the pandemic and people were placing double or triple orders to make sure they got those critical boxes, the supply chain got a bit full. We do believe that is over. So we'll see sort of how much of that decline may be a bit more structural, and will we be back sort of to that GDP minus kind of growth rate? And based on our prediction of, for boxes at least, 0.7, 0.8, 0.9% annual growth trend, that is, something like half of sort of where inflation, 2 to 2.1% inflation. We will be back to that GDP minus side. But slow and steady growth, and we do see recovery coming.
Awesome. Well, everybody, we'll all let you all go to lunch after you hear from Kaylee just in a second. Thanks for coming, and John, it was great to speak with you.
Thank you.